Morning, everybody. My name's Ed Brown. I'm one of the funding managers at Swoop, and I specialise in commercial mortgage and property finance, which is what we're going to be talking about today. So I think most people have joined. So Laura, am I okay to make a start?
Yeah, you can just begin.
Cool, thank you. Yeah, I did ask if we could remove the masterclass from the slide title, but was told in no uncertain terms that was remaining. So yeah, having done this for this role for about the last 5 years, I'm sort of acutely aware that very often it feels like we're sort of trying to arrange finance for people in sort of shifting sands. It's rarely a week that goes by that there's not a change in lender policy, criteria, appetite. So the idea of today is just to kind of give you a sense as to where we feel the market is at, share some of our experience with you. It's also relatively challenging to know where to pitch this in terms of the kind of level of detail and sort of some of the terminology and language that we use. So I'm sure that some of you will be very au fait and kind of deeply embedded in sort of commercial mortgages and property finance with some of your clients, and other people maybe are coming at this for the very first time. So there will be a Q&A session at the end. So if anybody has any questions, or they want me to revisit something or delve into something in a bit more detail, then more than happy to do that. In terms of the agenda, we're going to be packing quite a bit into the next 30 minutes. So I will very briefly reintroduce Swoop, because there's a slide that I absolutely love that encapsulates what Swoop is all about. I'll then introduce the team before we start looking at the sort of broader product offering. There's 6 product lines that I'm going to touch on today. We're going to delve in more detail into specifically commercial mortgages. And I'll explain the rationale for that when we get to that stage, and then I'll provide a sort of market update in terms of sentiment and what we're seeing in the market. Yeah, with hindsight, I probably would have put that earlier in the presentation, but that's probably why I'm a funding manager and not a trained presenter. We are also going to touch on why use a broker and an intermediary from the context of my current pipeline. So I'll explain where some of my deals have come from and why people are using us. And then we're going to rattle through a few case studies at the end to try and bring things to life for you as well, and touch on some of the key themes. So this is the slide that I love. It talks about all of the different areas in which Swoop is active. You'll see at the sort of top section, which refers to loans. Commercial mortgages is just one single strand on the chart there, and yet that's what myself and 2 of my colleagues dedicate our working lives to. So I think what this sort of slide says to me is that the broad variety of different funding that SMEs are trying to access, and also how complex the market is to navigate. I think Swoop does a great job of not only using technology to help people access these solutions, but also has different specialists that operate within each of these different areas that sort of sit behind the technology as well. So I think it's becoming increasingly difficult to be a generic broker that looks after all of these different areas. When you think that within the commercial mortgage and property channel, we probably deal with 40 to 50 lenders on a regular basis, and we have access to another 40 to 50 lenders sort of in the background as well. So it's yeah, a really broad church in terms of lenders and different solutions that we can put to play for clients. Brief intro to the team. There's 3 of us in the commercial mortgage and property finance team. Anne-Marie's a former NatWest RBS banker with 30 years experience. She's been with Swoop for the last 4 years. I've been working in financial services banking for the last 20 years. Predominantly, particularly in my earlier career, working in regulated lending before moving across into unregulated or commercial finance. And I've been working as a broker in this area since 2019. and Tom Gerard, who doesn't have quite as many miles on the clock as Anne-Marie and I, but he's been working in financial services for the last 8 years or so, and has some great experience in bridging and development finance, which is a really nice complement to Anne-Marie and I's and my background. Sorry, one thing I was going to say. So when we get a new inquiry, we will try to look at where that might sit, not just in terms of our sort of expertise over the years, but also in terms of live deals. As sort of referred back to those kind of constantly shifting stands at the start of the presentation, having some live deal experience in a particular sector or a particular area is really, really helpful when we're trying to position or place a deal in the wider market. So it doesn't always happen like that. We can all sort of pick up any area that I'm going to be touching on today, but sometimes if it's sort of handed off to one of our colleagues as sort of part of the process, that's normally the rationale as to why that's happened. So these are the 6 key product areas that we cover. You'll note at the top, I've referred to this as unregulated lending. We are authorised by the FCA. We do take our responsibilities with the regulator very seriously, but the actual products that we recommend and advise on are all unregulated. And I think that makes the importance, or makes the selection of professionals such as accountants, advisors, and finance brokers all the more important for our clients. I'm not going to delve on this slide into commercial mortgages, owner occupied, and investment property, because I've got a more detailed slide for those 2 areas later on. And the reason for that, when I was sort of prepping for this presentation, I ran through my pipeline, and both in terms of new inquiries and where my current pre-offer deals are sitting, they're pretty much all commercial mortgages in one format or another. If we'd have dialed the clock back a couple of years, where there was a greater emphasis on sort of lending to businesses post-COVID, there would have been a much higher proportion of bridging finance. And about 12 months ago, there would have been a higher focus on development finance. But yeah, where I'm sort of finding most of the new inquiries are at the moment is around the commercial mortgage market, which is why I'm going to focus on those areas shortly. Just very quickly to touch on the other 4 areas, but bridging finance, I think, is a sort of often misunderstood product. It's a short-term funding solution that can be used for a wide variety of different reasons, typically in place for 6 to 24 months, although we do have funders that will put in place a 36-month facility, and also one funder that offers an open-ended bridge. The normal sort of reason for wanting to put in place a bridging finance solution is either speed or an inability to demonstrate serviceability of a longer term solution, such as a mortgage. So those are the sort of primary reasons as to why they are utilised. They are more expensive than a commercial mortgage, but if they allow someone to take advantage of an opportunity or to resolve an issue, a sort of working capital issue or a funding issue within a business, then actually it's a price that is worth paying. It is a product that we, as a team, use relatively sparingly, but I've got lots of great examples where they've helped clients substantially, and we've then moved them on to a longer term funding solution at a later date. So I think there's probably a whole other session on bridging finance and development finance that we could run later for people if they're interested. I may as well touch on development finance, given I've just mentioned that. So we can help customers with anything from a refurbishment loan, where there's non-structural alterations to a property, but new kitchen, new bathroom, redecorating the property, right through to ground up development project for 15 new houses, and anything that sort of sits in between. So yeah, it's again a relatively broad church, and there are different sort of metrics that are applied to that. But yeah, that's in terms of development finance, the majority of inquiries that we get are around residential development, but we can also assist with commercial development schemes as well. In terms of mixed use, semi-commercial, it's a really interesting property class. The a sort of property type that's sat on the edges of lender appetite for a long time, but has increasingly come into the fold. My typical, I guess, mixed use semi-commercial scenario is a restaurant or a retail store, commercial of some aspect on the ground floor, and then residential apartments on the upper stories. So that might be a single story of residential, or 2, 3, 4 stories of residential above, and it's typically the commercial and the residential is sitting on one single title. The proportion of residential can have quite a strong bearing on the type of lender that we're willing to fund, and also the pricing that might be available. So some of the sharpest pricing that I'm seeing for semi-commercial starts with a 5 in terms of the interest rate, and that's where the majority, well, in fact, all of the affordability assessment is covered by the rental income from the residential properties. At the other end of the spectrum, pricing sort of around 8%, based on a relatively complex commercial arrangement on the lower floors. Also, just wanted to touch on residential property portfolio lending. Probably important to point out that we are not fantastic or ideally placed for people with a single asset buy-to-let. That's not really where our funders are focused. Our funders are much more focused on portfolio lends, so typically 5+ properties, and often there'll be a minimum loan amount of £500,000 or £1 million, depending on the funder. Typically, we are taking out multiple lenders, so somebody that's got 10, 15 lenders in play, secured against each individual asset, and we're bringing in a funder to simplify the portfolio, or we're helping somebody to acquire multiple assets as part of an expansion of their existing portfolio. One of the other areas that we've picked up quite a few deals over the last couple of years has been around customers that are looking to incorporate their portfolio. So people that have built up a portfolio in their personal names, and largely driven by the changes in taxation in the buy-to-let market, they are now looking to incorporate that into a limited company. It's a relatively complex area of taxation advice, which I do not claim to be any kind of expert on. But in terms of providing the funding solution to support customers on that journey, we do have lenders that are able to offer those solutions. So yeah, if you do come across people that are looking to do that, then we'd definitely be open to a conversation. So those are the kind of 6 key areas. As I said, I wanted to focus on commercial mortgages for owner-occupiers and commercial investment mortgages, because that seems to be the bulk of the inquiries that I'm getting at the moment. Obviously, it does ebb and flow as the market changes. So with an owner-occupied commercial mortgage, this is used to purchase or refinance property that will be used as the premises for the applicant or the applicant's business. So whether that's I don't know, somebody running an MOT test centre, and they've got the opportunity to acquire the premises that previously they've leased from a landlord. That would be a good example. Likewise, somebody that's looking to acquire a hotel whereby they will be trading and operating that hotel, and there's obviously a substantial property asset that comes with that. Again, owner occupied. Less of an issue. I quite often get asked if there's a sort of an opco-propco structure. So there's going to be one limited company that's going to own the property, and another limited company that's going to own the trading business. That's absolutely fine, as long as we can demonstrate that it's the same sort of beneficial owner of both of those entities, even if there are subtle differences in terms of minor shareholdings for a business partner, or husband or wife that's going to be part owning the property company. As long as we can demonstrate that it is the applicant's business that is going to trade from that property, we can create the link. And the rationale for doing that is that typically owner-occupied commercial mortgages are the cheapest cheaper out of the two forms of commercial mortgage. In terms of loan to value, that's normally the first question that we're asked. Typically, we can go up to 75% loan to value against the value of the bricks and mortar. I would say that high street banks tend to be more comfortable around 65 to 70% loan to value, and challenger banks generally more comfortable at that sort of 70 to 75%. But that is a generalization, and it will depend on the individual sectors that we're looking at. Also important to note that there are some sectors, such as hospitality and leisure, care sector, where there is a recognition of the value of the goodwill within that business, and lenders will be willing to gear up to a much higher level than 75%, in some cases exceeding 100% of the value of the bricks and mortar that underlies that business. So the example I often give is that of a care home acquisition. £1 million purchase price for a freehold care home. Valuer may value the business, the underlying property at around 600,000, which implies that the goodwill valuation is around sort of 400,000. Now, if you look at sort of typical commercial lending, 75% loan to value against the 600,000 would be 450,000. But in reality, for the right operator with the right experience and lots of other caveats, we could potentially get them up to 70% against the £1 million purchase price. So in effect, a £700,000 loan when the bricks and mortar is only worth 600,000 in that example. So that's just one example of how we can raise higher loan amounts against certain business types. I guess the other point I'd make as well is that although we may only be able to achieve 70 or 75% against the target asset, the property that is being bought or the property that's being refinanced, lenders will also consider other property assets. I'm probably pointing out the obvious here, but if the customer has equity in a buy-to-let portfolio, there may be an opportunity to increase the loan amount based on the additional security that we can provide elsewhere. There are costs involved in doing that, and there are calculations that would need to be undertaken on those properties. So it doesn't always work out, and sometimes the client may decide to put some additional cash in, but it can work well for somebody that has substantial equity in other properties elsewhere. I'd say the biggest challenge that we're facing at the moment in respect of probably across the market really is around the affordability assessment. So yes, customer always wants to ask about the loan to value, but actually one of the more important questions is what level of borrowing can the business actually support. Typically those affordability assessments are based on profit or EBITDA over the course of the last 2 years, but very often that's something that can be a challenge if there was a particular issue with a business 18 months ago that the business has now recovered from. So it's although the calculations that are applied by lenders are relatively rigid, there is an element of subjectivity around that, and a piece of narrative that we can add. And this is where things like forecasts can come in to help us to paint that picture for a lender, for an underwriter, so that they can understand the trajectory of the business and what's happened. And we can also isolate one-off instances, costs or reductions in profit that are linked to a specific cause. So as I say, that's probably been the biggest challenge that we've seen in the market. Previously, again, I'm going to generalize, but lenders might have been testing 3 or 4 years ago using a stressed interest rate at 5%. Now they'll be using a stressed interest rate of 8 or 9%. If your business is making the same £100,000 a year in profit, it's not going to be able to service the same level of debt based on those higher stress tests. So we have seen some sort of nips and tucks around this. Sorry, excuse me, the light's just gone off. But in the main, this is sort of what we've sort of seen is sort of lenders trying to find a way to react to that. But inevitably, I think that the total amount of borrowing that can be secured has reduced as a result of the change in base rate. Repayment profile typically 15 to 20 years, but that has shifted in recent years to 20 to 25 years, and particularly the challenger banks are sort of pushing that agenda. It does help with the serviceability assessment and allows the client to reduce monthly payments, which in turn helps with cash flow. Pricing, I put 1%. Realistically, the majority of owner-occupied commercial mortgages are broadly between a margin of between 2.5% and 4%. But we have got a few deals away that started with a 1. So 1.65, 1.75 over the course of the last 12 months. Those are rates that we haven't, or margins that we haven't really seen since pre-crash, so sort of 2006, 2007. So it is a significant improvement in the margins that are currently being offered in the market, but in part that's driven by the increase in base rate, and in reality, the pay rate that clients are paying is still higher now than it has been for several years. There are fixed rates available in the market, but the majority of but a significant proportion of deals in the marketplace are still written on variable rates. And there are still lots of lenders that we deal with that don't have a fixed rate offering. So it's a much more higher proportion of variable rates than you tend to see in perhaps residential lending, for example. I put on there that loans start at £100,000, but it is becoming increasingly difficult to secure a commercial mortgage below £250,000. Majority of challenger banks have a minimum loan amount which tends to be higher than that 100,000. We received notification this week from a major bank saying that actually new broker inquiries is going to be north of £250,000 sort of very soon. So I think the conversation that we tend to have with clients at that lower end of the spectrum is commercial mortgage, typical time to arrange, I guess, for somebody acquiring a property that they're going to trade from, 4, maybe 5 months. You're probably going to have setup costs of around £10,000 to £15,000 once you've factored in the valuation fee, the client's legals, and the lender's legal fees. And at that end of the market, you're probably looking at pricing at circa 8 to 10%. I would suggest, depending on the sector. There may be sort of better alternatives for the client, such as asset finance, leveraging some other assets within the business, or even an unsecured cash flow loan, where the pricing we've started to see on some of those loans reduce down to sort of circa 10%. It's sort of comparable with the pricing that we might see on a small commercial mortgage loan. So that's owner-occupied commercial mortgages. I also wanted to touch on commercial investment mortgages, which we seem to have had an increase in inquiries around. So this is where the owner of that property is going to be a landlord, and they're going to let that property via a commercial lease to an independent third-party tenant. The loan to values are typically slightly lower than we would experience with an owner-occupied commercial mortgage, and affordability is typically based on rental income, albeit some lenders will, most lenders will apply some sort of degree of caution to that, whether it's working on a 15, 20, 25% reduction based on the gross. And they'll also be very focused on the terms and conditions within that lease. So you could present exactly the same building to a funder, one with a brand new lease, 15 years in duration, without a break clause, and at a certain level of rent. You could present exactly the same property, but with a different tenant, with a 5-year lease with a 2-year break clause in favour of the tenant, and get a very, very different response. So the level of detail that we need to go into based within those leases is really important before we present that deal to funders. We've also seen a shift from more sort of traditional, particularly in the office space, traditional arrangements where an office block may have been let to 3 or 4 tenants, to a situation where we've got a substantial proportion of the property that is let to multiple tenants on short, 12-month tenancy agreements. So it's a much more fluid and more dynamic sort of tenancy than previously, and lenders will be assessing that in a different way. So as the market shifts, so is the way that the lenders are assessing those deals. I didn't touch on capital repayments, interest only on the previous section, owner occupied. 9 times out of 10, owner occupied commercial mortgages will be on capital repayment, albeit there may be a period of 12, 24 months interest only at the start. There is more availability of interest only within the commercial investment market, albeit a lot of lenders prefer to put the deal onto a 25 or 30-year repayment profile, so there is a small amount of capital being chipped away at each year. Pricing slightly higher, 2% above Bank of England base rate is typically where it would start, and I'd say that more typically it's sort of 3 to 4% margins. And again, I've sort of referenced there the loans from sort of 250,000. So I'd always say, with all of these things, that there is some fluidity, and there are options available in the market for lots and lots of different scenarios. So this is just trying to give you a general sense as to where things sit, so that it might help empower your conversations with clients. So quick update in terms of what we're seeing in the marketplace. I think there's a sort of general sort of trend or sort of widely covered story of high street banks cutting costs, shedding staff, and challenger banks being these new dynamic banks that are sort of taking market share, and the sort of growth of the secondary market. And I think that's broadly still true, but some of the challenger banks have been around for 10 plus years now, and actually their appetite in certain sectors sort of waxed and waned, and within certain sectors the high street are still market leaders. If I think of a dental practice, I would immediately be thinking of some of the high street bank options that are available out there, and their ability to price is probably second to none, although sometimes the challengers can get close or pip them. So I think that I guess what I'm saying is that the market is becoming more mature, it's becoming more complex, and again, I guess that's why I sort of come back to the value and the role that we can play as an intermediary in helping the client to navigate that. I couldn't do a session without touching on Bank of England base rate change. First change in 3 years that we've seen. So it's after 14 consecutive rises, it's been good to see a slight reduction in Bank of England base rate. As I've touched on, why that's important is around the kind of driver for the pricing of a deal, and also the servicing and sort of affordability assessment of a deal. And we hope that with if there is a further reduction next year in base rate, we may see some further moderation of those sensitivity tests that are applied, and that may make accessing funding for certain businesses a little bit easier. I don't think that we're expecting to go back to the stress tests that were applied when Bank of England base rate was 0.5%, but I think yeah, we're hoping to see some reduction in some of those sensitivity analysis. One of the things that I've mentioned has been the squeeze on margin, and those kind of very strong price deals that started with a 1. So we've seen some squeezing of margin, and we've also seen lenders offer very competitive fixed rates. So those fixed rates have reflected the fact that the bank is expecting Bank of England base rate to fall at some point, and they are offering part of that reduction to customers. So pay rate at 7.5%, which includes Bank of England plus the margin. That same customer may be offered a 5-year fixed rate at 6.8%, as an example. So there's actually a reduction from the pay rate based on the fact that the customer is signing up to a 5-year fix. Government growth scheme is the latest iteration of sort of British business bank support for the market. It's still early days. I have one funder that it was straight out the blocks with this and has a very coherent sort of strategy around it. Other lenders, I think, are still working out what this will mean and how they will incorporate it into their product offering. I guess the important thing, unlike CBILS, which was launched during COVID, this doesn't necessarily mean that there won't be personal guarantees and that pricing will be set at a certain level. It's designed as a scheme to encourage lenders to continue lending and to support lenders rather than the actual end user. Although ultimately that should mean that there is more liquidity in the market and there are more deals available to people that are looking to borrow. And then just lastly, I was going to touch on green mortgages, which is my sort of term for it. It seems as though there's an increasing activity from lenders within this space within the market. I think it's largely driven by their own ESG agendas, but I think it's worth, if you are talking to customers that are potentially looking at investing in the fabric of the building, insulation, solar panels. We would obviously look at that in the round, is asset finance, for example, for solar panels the route to go down, or is looking at refinancing the existing mortgage potential route because of the potential reduction in pricing because it's classified as a green mortgage. So it's a small, what we're seeing is a small reduction in the pricing on those sort of deals to reflect the investment that's been put into the buildings. Yeah, just quickly to touch on why you Swoop. I am conscious that I'm already overrunning and I've got a few case studies to go through. So when I looked at my pipeline, I think that there were a few themes that jumped out at me. One was customer had been with a bank for several years, but because they didn't have any existing borrowing or their turnover was below a certain level, they did not know how to navigate the bank to even start to have a conversation about borrowing £500,000 to buy their first commercial property. Other instances where they had managed to have those conversations and been rejected. And I also have a lot of clients that are looking to do something where such as acquire a business for the first time. So first-time borrowers and first-time buyers of things like hotels and care homes, where we have lots of transferable skills, but they're not quite sure how to present those transferable skills in a way that is acceptable to the bank. And I think that that's where we can add significant value. So those are probably my kind of 3 key themes that are coming through the sort of customers that I'm currently dealing with. Of course, there's absolutely the ability for us to run a competitive process with the market. We've got a huge range of different lenders that we can go out to, but I think it's that value add that we can bring to the client in terms of helping them to access, whether it's their own incumbent bank or whether it's running a process with a broader market for their particular deal. So a few case studies. So this first one is an owner-occupied commercial mortgage. It's a private dental practice. They currently banked with a high street, and they hadn't been offered a fantastic follow-on rate. The relationship had broken down. This is a key theme. Change in relationship manager a couple of times in quick succession. And they didn't feel as though they were being looked after. One of the complexities of this as well is that they had introduced around £200,000 of their own funds during COVID, and they now wanted to take those funds back out of the business. That is something that the high street in particular are relatively cautious around. They are fearful of the detrimental impact that might have on the business. But I went out and spoke to high street banks and challenger banks, our usual kind of broad approach to the market. But this was actually a challenger bank. It was willing to offer a 5-year facility, 5.9% fixed for 5 years. Yeah, 1.5 million, including capital raise and funds out of the deal. Another owner-occupied commercial mortgage, loan amount of £550,000. Existing convenience store operator that was looking to acquire a new convenience store, which included the freehold. With this particular scenario, we were actually able to raise some additional funds against their existing business and offer the new property as security as well. Which meant that the client had to put minimal cash into the transaction. They covered legal costs and fees. That's probably also worth mentioning the kind of subtle difference between high street and challenger. High street tend to prefer more cash into the transaction than a challenger bank. It's not always the case, but as I say, as a sort of generalization, that is something to look out for. Ideally, we are looking for clients to be able to put in a small amount of cash to the transaction, but certainly where they're introducing a new property, that can be taken in lieu of cash. Development exit. Not really talked much about development today, but we have definitely seen an increase in schemes that have overrun, both from a time and from a cost perspective. And this is one such example. Existing development facility, a good relationship with the development finance lender, but I think this particular one was a relatively complex build, and the pricing on the loan was just over 1%. We've been able to put in place a development exit solution, which gives the customer 12 months to actually market and sell the properties in their own pace. They're already being marketed, but it gives them 12 months to actually get the completions away. And that was at 0.85%. So it was a decent reduction from the existing development finance facility, and gives the breathing space to be able to sell those properties without feeling like there's a time pressure to have to reduce prices and shift them quickly. This is a residential property portfolio refinance, a £1.65 million facility secured across multiple properties. The relationship had broken down with their current lender. Various reasons for that, including COVID and the impact that had on rental income. But actually, the portfolio was performing well at the point at which we were taking the deal out to market. And we were able to attract far more competitive terms than the existing funder would have been able to offer anyway. So that was a really good outcome for the individual, who was also able to raise a small amount of additional funds to go and buy some additional property. And then just lastly, this is a first-time buyer of a care home. This kind of reverts back to that ability to raise funds at more than the underlying value of the bricks and mortar in certain instances. This was an experienced entrepreneur. They didn't have direct sector experience, although they did have substantial experience of working within a regulated environment. and the business that they were acquiring had a really experienced and stable management team. And there was a cohesive business plan, yeah, it made sense for a lot of reasons, and we're able to secure a loan at 70% against the purchase price. So he says, drawing breath. That was a kind of whistle-stop tour that I've significantly overrun my allotted 30 minutes on. So apologies for taking up too much of your time, but I will, yeah, just see if there's any questions that have kind of come out through the process. So somebody has asked where we can view rates on commercial investment properties and our other products. So Harry, we're an intermediary. So we would be going out to market, identifying lenders that are able to provide a funding solution to you and presenting those options back. We can, at the early stages of the process, give you an indication as to where we think pricing is likely to sit. But it will only be once we've actually gone out to lenders as to what the pricing of your particular deal will look like. There are sort of, to an extent, off-the-shelf products within commercial investment, but a lot of lenders will price bespoke based on the strength of the covenant, the asset type, and the sector in which those properties sit. So yeah, hopefully that gives you a sort of vague but relatively specific answer. We've got another question from David Gelkin asking whether our services are available internationally or UK specific. Really good question, and I probably should have talked about that when I introduced Swoop right at the start. So we do have offices based in Toronto, Cape Town, Sydney, Dublin, as well as 4 offices in the UK. And yes, we are able to offer funding solutions within those jurisdictions. We are, in some instances, also able to offer some funding solutions within Europe, although at the moment they are relatively limited. So it's definitely worth having a conversation. I've recently funded a property investor in the UK who came to us, based over in Canada, came to us via our Toronto office. And we were able to find a solution for them in the UK market. And for me, again, that's where we sort of differentiate ourselves, using the Swoop network in multiple countries. Another question from Harry Sandu. What actually defines the pricing for semi-commercial? Is it floor space like Alica, who are one of the lenders that classify them as a challenger bank, or on property value like Interbay? I assume you need at least 50% of the floor space to get the best rates. Yes, is the honest answer. So yeah, it is a combination of the two. Different funders will assess in slightly different ways, and that's where we will be looking for details prior to submitting that to market. What we don't want to do is have the client pay for a valuation that we know isn't going to work for a particular funder. So yeah, we do still have funders that will lend against semi-commercial assets, even if the residential element is a relatively small percentage overall. But you will then be paying more like commercial rates for that lend. Yeah, another question: do lenders like no break clauses in regards to commercial investment? So if there's a lease without a break clause, then yes, that would be preferable to funders, but because it provides additional security. I should probably also specify that a break clause to the advantage of the freeholder is actually a further advantage to the lender. It's the break clause in favour of the tenant that could potentially pose a potential risk. It's also further complicated by the location of the asset. It could be that the valuer passes comments, say it's a high demand area, and that actually it's a highly desirable property, and the likelihood of a void will be relatively remote. I'm not sure I've seen a valuation report quite so glowing as that, but you kind of get the sentiment of it. So the comments from the valuer are going to be critical here in terms of how long those void periods, if there is indeed going to be one, is likely to last for. So in a perfect world, there'd be no break clauses, and that would be fantastic. In reality, most leases will have some sort of break clause, and lenders will be looking at ways in which they can mitigate that. I guess the other point that I would make as well is you may have a building with multiple tenants, in which case there will always be one lease that is rolling off, whether that's a break clause or a lease that is coming to the end of its duration. So these things aren't potentially as clear cut as no break clause good and break clause bad. It's not that straightforward. Okay, looks like that's the end of the questions. So thank you for putting up with me for as long as I've gone on for, which was well over the allotted time. And if you would like to follow up, I believe there'll be an email coming out to everybody with a copy of the video, and also our contact details if you want to reach out to one of us to ask any further questions. Thank you all for listening, and hopefully I will speak to some of you soon.